Turn to the markets on the day after the Fed decision. Joining us right now to talk stocks, IPOs, and tech investing is Glen Kacher. He is founder and CIO at Light Street Capital. And I guess, Glenn, let's just start from the perspective of how much money is sloshing around out there right now because of the Fed's policies. More easy monetary policy means more money is going to be there. And what does that mean for the IPO market and for the private markets where you play?
Sure. Well, I think we're at kind of a turning point for the IPO markets. Over the last several years, there's been so much capital, both from private players and public players going into these late-stage financings. So that by the time these companies want to go public, they don't really need any more capital. They've stayed private 3, 4, or 4 more years longer than typical. And there's a real movement going on in Silicon Valley, a groundswell of investors that are saying, we don't need to take further dilution in an IPO. And in a few weeks, there's going to be the top 20, most of the top 20 venture firms and about 100 private companies are going to get together and talk about maybe we don't do IPOs anymore. Maybe direct listings is the way to go public.
That sounds like a little bit of BS. I mean,
well,
just in terms of like watching what's happened, because it seems to me that a lot of these companies have come public not because they want to, but because they have to. Yeah.
Well, we'll see. The ones that don't need to go public and that don't need the capital are, fully capable.
But that's the fundamental question.
Yes.
Which is to say a direct listing only makes sense insofar as you don't need the capital, at least in the absolute immediate term. But what you do have is people coming online through direct listing and then 3-6 months later trying to raise money in the public market.
Yeah, but we've seen, companies like Spotify, companies like Slack. Slack was, break even almost break even in the most recent quarter. And the business is going very well. They don't need outside capital. They don't need further dilution.
We should point out you have had holdings in Uber, Lyft, Pinterest, and Slack. Those have been ones that you've been involved in.
Yeah, and Pinterest didn't need capital either.
What do you think about private valuations versus public valuations and the idea that transparency in the public market has demonstrated, at least to the degree you think that the public market is a better way to value things, that there's actually something wrong in the private markets? And I think it's especially important because actually now there are public investors, meaning Blackstone, T. Rowe Price, BlackRock, T. Rowe Price, and some of the big public investors that are now in these private vehicles.
Sure. I mean, more supply of capital and drives up prices. So we've seen valuations get done in private companies that we hadn't seen before 5 or 10 years ago. So I think there's an adjustment. I think what's happening really is that the IPOs are happening in the private market. That's where IPOs are actually happening. They're just a select group of investors that are doing them, and then the public IPO is a separate event. And I think the public market investors are pretty good arbiters of value, and those values have to hold up over time, and that's going to come down to the fundamentals of the companies. And that's what markets, open outcry markets that we live in as public market investors do. So, let the markets do their function.
Does it feel to you that there's any sort of a tipping point or any sort of a turn in terms of how willing the retail markets are to take some of these new deals? I mean, you've seen some recent listings that haven't done well.
Yeah.
You've also seen WeWork look like it may not ever come to market. We'll see.
Yeah.
But does that feel like a turning point to you?
I think those are two pretty separate things. We've also had a general stock market where there's been some questions about whether, what's happening with this value growth rotation. And that's obviously not good for high growth companies, which typically, is what we see come out of Silicon Valley venture-backed companies. So WeWork, I think, look, there's a company that I think there's been plenty said about some of the behaviors, some of the policies, and frankly, the business model there. I don't really consider WeWork to be a technology.
Right.
They were cobbling together some software technology to put a technology veneer on the business, but there's nothing there that really gives you the pooling efficiency that technology companies and that real sharing economy companies like Uber and Lyft.
It still requires capital expenditures, not like other tech companies.
It's not just capital expenditures. When you and I take a Lyft or an Uber, that's a property or an asset that's been used 10, 20 times a day by different users. When you rent a cubicle at WeWork or 3 or 4 cubicles for your startup, no one else is using those square feet all day. So there's really no pooling efficiencies there.
Do you have concerns about Uber and Lyft, given some of the regulatory advances that we've seen, not only in California, but here in New York City, other places where it may make it tougher for there to be for those companies to turn a profit anytime soon?
Hey, they've got to live by the rules that that our legislators bring to the table, and there will be new ones, and we'll see how that works out. I mean, I think with AB 5, the new legislation in California, if that transition occurs for some percentage of drivers, it gives both Uber and Lyft the opportunity to both require their drivers to do things they weren't able to require, meaning work certain hours, work certain locations, and also restrict them from working for the competition, which would reduce churn of drivers, which is a major cost to both of those companies. So I think there's two sides to some of the opportunity to have a certain percentage of your employees or a certain percentage of your drivers to be employees. And so we'll see how that works out. I think the core attractiveness of both those stocks is the benign pricing environment in the U.S. This is a duopoly business. Sure, there's a few small competitors in various cities, but ride sharing is largely a two-player business or market in the United States, and we've seen pricing go up dramatically. Lyft, which only does business in ride sharing, they don't have a food delivery business, and they don't operate outside of the U.S. and Canada. I think you're going to see their fundamentals do really well very quickly. And so we've got a big position in Lyft.
Glenn, I want to thank you for your time today. It's good to see you.
Yeah, I appreciate it.